Right now, as I'm recording this video, KASPA is sitting in one of the most dangerous positions I've seen all year. The Bollinger Bands are squeezing tighter than a vice grip, institutional money is quietly flowing out of exchanges, and community sentiment has crashed to its lowest point in a month. But here's what's really wild. This exact same setup happened in October 2023, just before KASPA went absolutely ballistic. So the question isn't whether a massive move is coming. The question is which direction it's going, and whether you'll be positioned correctly when it happens. Let me show you something that should have every KASPA holder paying attention right now. The bands are contracting at an aggressive rate, heading toward the same low volatility levels we witnessed 15 months ago. For those who weren't around back then, October 2023 marked one of the most explosive periods in KASPA's trading history. The market went from dead silent to absolutely nuclear in a matter of days. Technical analysis tells us that when Bollinger Bands contract this aggressively, it's not a question of if volatility returns, it's when. And historically, the longer the compression, the more violent the eventual breakout becomes. Now, while retail traders are focused on price action, something much more significant is happening behind the scenes. In the last 24 hours alone, 9 out of the 10 largest KASPA withdrawals came directly from exchange wallets. We're not talking about small fish here. These are whale-sized movements that continue a broader trend of institutional capital leaving centralized exchanges. This institutional exodus tells us two critical things. First, smart money is positioning for longer-term holds rather than quick flips. Second, the available supply on exchanges is shrinking, which historically creates the perfect conditions for supply shock rallies. When you combine decreasing exchange inventory with KASPA's already limited circulating supply, you're looking at a potential powder keg that could explode with relatively small buying pressure. Meanwhile, the infrastructure around KASPA continues expanding despite the price consolidation. OKX users can now swap KASPA directly through CSwap, adding another layer of accessibility for institutional traders. These aren't flashy announcements that pump prices overnight, but they're the foundation stones that support sustainable long-term growth. But not everything is sunshine and rainbows in KASPA land. According to KASPA Daily's latest sentiment analysis, community confidence has plummeted to its lowest level in a month. The primary culprit? Uncertainty surrounding the upcoming Layer 2 launch. This sentiment crash isn't unusual before major technological milestones. We've seen similar patterns with Bitcoin before halving events, Ethereum before major upgrades, and countless other projects before significant developments. Fear of the unknown often creates temporary selling pressure, but it also creates opportunity for those who understand the bigger picture. And then there's the Hashrate controversy that's been spreading like wildfire across crypto Twitter. Critics are throwing around alarming headlines. KASPA's Hashrate is dropping. Miners are abandoning ship. The network is dying. KASPA Ace just dropped an absolute masterclass thread destroying these narratives piece by piece, and I need to walk you through his analysis because it reveals how fundamentally misunderstood KASPA's security model really is. First, the idea that declining Hashrate equals a dying project. This is crypto mythology at its worst. Bitcoin's Hashrate in 2011 followed an almost identical pattern to what we're seeing with KASPA today. Rapid rise, sharp peak, steep drawdown. That period didn't mark Bitcoin's death. It preceded its strongest growth phase in history. Hashrate is cyclical because mining is a business driven by profitability, hardware availability, and energy costs. When these factors shift, miners adjust accordingly. It's market dynamics, not project fundamentals. But the security argument is where critics really miss the mark. They're applying linear blockchain thinking to a BlockDAG architecture, and it's like trying to analyze a Formula One car using horse and buggy metrics. KASPA's security isn't just about raw Hashrate numbers, it's about how that Hashrate is organized through BlockDAG consensus. In traditional blockchains, faster block times create orphan rates that waste honest mining work. Attackers can exploit this inefficiency. KASPA flips this completely. The network expects multiple parallel blocks at roughly 10 blocks per second, then orders them through BlockDAG. Instead of discarding honest work like traditional chains, KASPA includes it all. An attacker must overcome nearly the entire honest network, not just the portion that survives orphan elimination. The reorg resistance is particularly fascinating. An attacker must outproduce and outconnect that fabric, exponentially harder than extending a single chain. The critics also fundamentally misunderstand mining economics. Hashrate follows three primary drivers: price per hash revenue, hardware upgrade cycles, and energy cost fluctuations. Bitcoin experienced multi-month Hashrate drawdowns in 2011, 2014, and 2018, then achieved new all-time highs each time. KASPA's hundreds of petahashes today represent substantial security relative to its market cap. The network maintains decentralization through fair launch principles, zero premium, no venture capital allocation, open proof-of-work participation, and globally distributed nodes. Diving into the technical picture, the 4-hour chart reveals a textbook compression pattern that could resolve explosively in either direction. Price has been making lower highs since the last significant move, but those higher lows from earlier are still intact. This creates a contracting triangle that's building pressure like a coiled spring. The make-or-break level sits around 82 cents to 80 cents. Every single dip into this zone has attracted aggressive buying, suggesting institutional support at these levels. This isn't retail FOMO. This is calculated accumulation by sophisticated traders who understand KASPA's long-term potential. If that support fails, the next logical target drops to 78 cents, 77 cents, which marked the launch point for the last major rally. A break below that level would signal a deeper correction, potentially targeting 75 cents. On the upside, reclaiming 85 cents, 86 cents would confirm that this pullback is merely a healthy reset. From there, price could challenge the 90 cents, 92 cents resistance zone that proved problematic throughout August. Current momentum has decelerated compared to last week's bullish push, but today's decline occurred on average volume. This suggests profit-taking rather than panic selling, a crucial distinction that separates temporary corrections from trend reversals. Derivatives data supports this interpretation. Open interest remains steady, indicating traders are maintaining positions rather than fleeing. Funding rates are neutral, showing the market isn't overly leveraged in either direction. The consistent pattern of large withdrawals from centralized exchanges deserves deeper analysis. When institutional players move significant positions off exchanges, they're typically preparing for longer holding periods. This reduces immediate selling pressure and creates potential supply shortages during demand spikes. Historical data shows that sustained exchange outflows often precede major price movements. The mechanism is straightforward. Less available supply on exchanges means larger price impact from incoming buy orders. The upcoming Layer 2 implementation represents both opportunity and risk. Major protocol upgrades historically create short-term uncertainty, followed by adoption-driven growth. Sophisticated investors often use pre-launch uncertainty to accumulate positions at discounted prices. The temporary sentiment weakness could be creating exactly this type of opportunity. KASPA's current consolidation is occurring against a backdrop of broader cryptocurrency market stabilization. Based on current technical indicators, market structure, and fundamental developments, I'm seeing three primary scenarios playing out over the next 2 to 4 weeks. Scenario 1. The bullish breakout. If buying pressure returns and price reclaims 86 cents decisively, we could see rapid movement toward 90 cents, 92 cents, with potential for higher targets if momentum accelerates. Probability, 35%. Scenario 2. The bearish breakdown. If support at 80 cents fails and selling pressure intensifies, expect a test of 78 cents, 77 cents with $0. 75 as the ultimate downside target. Probability, 25%. Scenario 3. Extended consolidation. Price continues chopping between 80 cents and 90 cents as the market awaits clarity on Layer 2 developments and broader adoption metrics. Probability, 40%. For active traders, the current setup offers defined risk parameters. Long positions above 86 cents with stops below 80 cents provide favorable risk-reward ratios targeting 92 cents. Conversely, breakdown trades below 80 cents targeting 77 cents offer similar asymmetric potential. Long-term investors might view current weakness as accumulation opportunity, particularly given the institutional outflow trends and upcoming technological developments. The key is position sizing appropriately and understanding that cryptocurrency investments carry inherent volatility. The Layer 2 launch timeline will likely determine near-term price direction. Successful implementation could trigger adoption-driven buying, while delays or technical issues might extend the current uncertainty. Monitoring development updates and community sentiment indicators will be crucial for timing decisions. KASPA's current position reminds me of coiled energy waiting for release. The Bollinger Band compression, exchange outflows, and pre-catalyst uncertainty are creating conditions similar to October 2023, when patient holders were rewarded with explosive gains. Whether that energy releases upward or downward depends on execution of upcoming developments and broader market conditions. But one thing is certain, this quiet period won't last forever, and the eventual move will likely be significant enough to create both winners and losers. The smart money is positioning now, while retail traders debate Hashrate FUD and sentiment metrics. History suggests that periods of maximum uncertainty often precede periods of maximum opportunity. Stay alert, manage your risk appropriately, and remember that in cryptocurrency markets the biggest moves often come when you least expect them. Disclaimer. This content is for educational and entertainment purposes only, and should not be considered financial advice. Cryptocurrency investments carry significant risk, including the potential for total loss of capital. Past performance does not guarantee future results. Always conduct your own research and consult with qualified financial advisors before making investment decisions. I may hold positions in the cryptocurrencies discussed in this video. Market conditions change rapidly, and the analysis presented here may become outdated. Never invest more than you can afford to lose, and be aware that cryptocurrency markets are highly volatile and speculative.